Okay, hello everyone, and welcome to today's STA open call titled Outsourcing by Investment Advisors. STA's open calls are brought to you by the STA Foundation, a 501c3 corporation, which serves as STA's educational arm. Now, today we will be discussing the SEC's proposed new rule and rule amendments, which would prohibit SEC-registered investment advisors from outsourcing certain services and functions without conducting due diligence and monitoring of their service providers. Now, like all open calls, our goal today here is to just raise awareness on the broad implications that the SEC's proposal has on RIAs of all sizes and also the service providers who live in this space. We have two excellent presenters for you today, but before I introduce them, I just want to first explain how STA came to the decision to organize this call, because it is a little bit outside of our market structure type subjects that we normally cover on these things. And then I'll do my best to cover the outline 232-page rule filing as soon as as quickly as possible. All right, so listen, how did STA come to decide on doing this call? Listen, in September and then again in October, we held panel discussions on the growth of outsourced or supplementary trading relationships. This is obviously a growing area, and we have a lot of members interested in the topic. Therefore, when this proposal was dropped in late October, we obviously wanted to understand how it would impact this one segment of the marketplace. Now, you only need to get around 5 or 10 pages into the filing to realize that the proposal covers a much larger area than just trading. And again, the requirements here are not just, it isn't just a broad scope of topics that are being covered here. The requirements that are in the proposal are very prescriptive. Now, the proposed rule would apply to SEC-registered advisors that seek to outsource record keeping or functions that are, one, necessary to provide advisory services in compliance with the federal securities laws, and two, if not performed or performed negligently, would be reasonably likely to cause material negative impact on the advisor's clients or the advisor's abilities to provide investment advisory services. The requirements kind of include a bunch of new definitions, like most proposals here. Well, not necessarily new, but they require definitions on areas that we're going to try to cover some of the more important ones tonight. What is a covered function? What is a service provider? What is the criteria for satisfying due diligence when selecting a service provider? What are the monitoring and reassessment requirements of existing outsourced relations? And what are the requirements for maintaining proper books and records? And there's also here, the amendment part is about the new reporting requirements of a firm's Form ADV. Now, if the proposed amendments are adopted, they would obviously have significant impact on the due diligence and monitoring obligations of SEC-registered investment advisors. So with that, here to explain it today is Jeff Esteller and David Laurie. For those who don't know Jeff, he is the founder of Esteller LLC, an independent consulting and advisory firm to the financial services and legal community. Jeff has extensive experience in global equity trading, compliance, investment operations, risk management, securities market structure, public policy, global regulation, and the implementation of technology efficiencies. And that is because before founding Esteller LLC, Jeff spent 20 years at MFS Investment Management, where he held various roles in global equity trading, trading analytics, and also director of investment operations. Joining Jeff here is Dave Laurie, who serves as vice president and senior counsel, regulatory affairs for the Managed Funds Association, also known as MFA. David has extensive experience working in the alternative investment industry. Notably, David served as the chief compliance officer at the private equity firm Kresley and Company. I'm sorry if I mispronounced the firm, David, where he was responsible for all regulatory matters. And David also worked at Ascendant Compliance Management, where he consulted on regulatory issues for over 100 clients that included hedge funds, private equity firms, and investment advisors across the country. Okay, so there we go. There's the intro. We're going to go. We're going to try to cover 4 or 5 questions here today. We're going to start with Jeff. Jeff, let's just start with you. Okay, now I mentioned, our initial curiosity here was how the proposal would affect outsourced or supplementary trading, but maybe you could kind of take us a step back here and take a moment to provide an overview of how we got where we are today, and why is the SEC so focused on outsourcing that's being done by RIAs?
Perfect, Jim. Thanks for the opportunity for having me today. And I agree, we need to step back. I mean, the SEC came out with a proposed rule, 200 plus pages. And yes, outsourced trading was certainly mentioned in it. But if we look at the broader perspective and you really think of the different covered functions, and is much deeper and wider than outsourced trading. It's important to think of the current state of the industry, the competitive nature of the industry, defining an investment advisor. So it's mutual funds, hedge funds, pensions, registered investment advisors, right? So that's all, when we think about the definitional approach, all of those entities, those investment advisors, have core value proposition. And their core value proposition, at least in my opinion, it's alpha generation, alpha retention, and servicing of their clients. And if that's the core value proposition of those entities, everything on the periphery of that is something that most successful investment advisors consider retaining some third-party help. You could call it outsourcing, you call it supplemental. And this isn't new. I mean, these types of relationships have been around for years. Some of them are fully outsourced. Think of a custody or custodial relationship that's fully outsourced. And then we have supplemental or partial outsourcing, and that could be, corporate actions. That could be, trading in a region. It could be, the valuation of certain securities could be partially or supplemental outsourced. And the good news is the SEC, agrees that service providers provide important function to investment advisors, that it's okay and it's actually encouraged with the proper due diligence and monitoring and key performance indicators around these relationships. And so the good news is the SEC, values these incremental relationships that all investment advisors have today and potentially could expand in the future. You touched on kind of the scope of these different type of relationships, and listed right in the proposed rule is, when you think of covered functions, investment research and data analytics, trading and risk management, compliance, settlement, pricing and valuation, performance, index calculations, and technology such as order management systems or execution management systems. And so that's really, kind of how I look at the current state. The next question, Jim, is why now? Why is the SEC putting this in front of us with everything else that the industry is focused on? And in my view, it comes down to one of the core pillars of the SEC. It's investor protection. In the rule proposal, the SEC did touch upon some of their concerns that they have with the risk that investors could be exposed to if their investment advisor is outsourcing away from traditional best practices without the right oversight. And some of the concerns and issues that the SEC has bumped into over different inspections is failure to perform proper due diligence. And are the outsourced services performing as intended? Failure to oversee these third-party vendors, and how do those vendors safeguard personal identifying information? What type of documents can be, produced quickly for due diligence purposes? And, as a consumer, as an asset owner, could be retail or institutional, is there a clean and standardized way for an investment advisor to share to, the marketplace on what type of outsourcing relationships they have in place? And so I think that's, there's a long intro, but you think of why are we here? What's the current state, and what's the commission's perspective? I think you're muted, Jim.
Sorry about that. It's right in some of the conversation that we have with regulators, also as it pertains to just with broker dealers and their vendor relationships. And it is like a double-edged sword here. On the one hand, if a new proposal or a new rule comes into place, if one vendor gets it right, then you can be assured that 100 or 200 broker dealers will get it right. So you kind of eliminate that risk of being done multiple different ways. On the other hand, though, there are challenges with having the vendor also in the equation as far as implementing new rules that come in place. A broker dealer cannot do any work until the vendor actually gets gets the, you know, the work done themselves internally, and that those two projects are separate and they don't go side by side. David, I want to just come over to you now, because I think that when I read this thing, and I went through it, I mean, obviously some of the processes that the proposal addresses, you know, they are being done today. You know, RIAs, you know, they do conduct due diligence when choosing a service provider. I'm sure they're also monitoring their performance, but how is the proposal different than what the industry is already doing today in this area around, you know, outsourcing services?
Yeah, thanks, Jim, and thanks for having me. So this is this rule is very different than what's currently being done. You know, I would have two key themes here. One, this is really going to have a massive impact. And two, I know Jeff already used the word prescriptive. This is an extremely prescriptive rule, and it's an extremely broad rule. So to the points being made, certainly currently very important, and we're all very supportive of any you know, registered firm doing their due diligence on their vendors. They already have obligations, obviously, to their investors, and also obligations under the Advisors Act to do so. What this rule does is it takes it to another level of prescriptiveness and breadth. So, for example, to you know, to Jeff's earlier points on covered functions and outsourcing, I'd like to make a couple points here to talk about how it's different. So first of all, in the rule, which Jim noted was 232 pages, so there's a lot there, and that's actually kind of short for this staff. In the rule, when we think of outsourcing, like in the ordinary course of business, we're thinking you're outsourcing that part, you're giving up control, engaging it with, or, you know, giving it to the service provider. Under the reading of the rule, actually anything is an outsourced function if you're just even engaging a third party. So the sheer amount of third parties that a firm is engaging with is substantial. So this rule right there alone is extremely broad. Moreover, the covered function, the SEC gives kind of a two-pronged definition. So to Jim and Jeff's point, you have to be doing initial and ongoing due diligence if one of these service providers is performing a quote covered function for you. That again is extremely broad. So some of the examples Jeff gave, absolutely. But the way that the rule is read right now, really a covered function would be almost anything when you're engaging a service provider. Extremely broad. Where do you draw the line? One of the things that we do at MFA is, you know, we're in the process of working with our members and drafting a comment letter response to the SEC to make recommendations, and certainly narrowing the definition of covered function is extremely important. You know, I think that we feel and firms feel it really should be something that is related to the provision of providing your investment advisory services. And there's got to be kind of a real narrow definition there. There's also a concern that advisors are going to be held to a negligence standard for third parties. And even further out, it's a very scary thought. You know, that's also come up in some other rulemaking, like the private fund advisor rule and et cetera. So while certainly all of us are really supportive, and it's a fiduciary duty, absolutely, to do diligence on your service providers, this is a very prescriptive rule, a very broad rule. And I guess the last point is, you know, to your point earlier, Jim, I feel like, you know, we feel like a lot of people, this is kind of a solution in search of a problem. I think that, you know, firms are currently doing this really well. Disclosure to their investors. This is part of SEC exams. You're now creating an entire prescriptive regime that's trying to do kind of this like check the box approach, but it's very burdensome. It's very onerous, and you know, a lot of concerns with it. Sorry, Jim, I think you're on mute.
That's twice. I'm just going to leave it up. I'm sorry. It's really windy, and I just I don't want to catch like, and you know, and the windows are kind of cheap in my house, so it's a lot of rattling. I'm sorry. I'll keep it off mute. Listen, you know, you mentioned obviously that firms and these functions are being performed today. A lot of the firms are doing them efficiently and they're doing very conscientiously and doing it well. I guess my question to you is, because I know, is that if a firm wasn't doing it well and an investor was harmed, that investor does have some type of recourse, right? It's not like there is. So I guess my question here is like, what is the level of investment protection today? Like what exists today for that protects investors in the event that they are harmed?
Yeah. Jeff, I'll jump in real quick if that's okay.
Yeah.
So under the current existing legal and regulatory framework, absolutely. So any SEC registered advisor has a fiduciary duty under the Advisors Act to act in the best interest of their clients, to have full and fair disclosure, and also to have and implement, policies and procedures designed to ensure that, including with the use of service providers. So having, and I know Jeff has got a ton of in-house experience, and lots of people on this call, you have to do this stuff. Investors are protected. What this rule does is it really amps it up a notch where you're now potentially looking at, I don't know, 100 vendors, more than that, and conducting like really extensive due diligence. And in some areas, really unclear how you even get that level of diligence. There's stuff in that rule on, the service providers, like subcontracting arrangements, affiliates. I mean, it goes into a level of granularity and depth that, based on, at MFA, we've had a couple of calls with our steering committee, probably about 100, pretty, good member firms on there. This is pretty unheard of.
All right, Jeff, let's swing it back to you here. So, as we talked about a couple of times, it's a 230-page, proposal. We got around 30 minutes here. If you had to pick one or two areas or requirements where you believe an RIA would struggle to comply with that requirement, and when I want to be clear, when I say struggle to comply, I mean either from a technology / cost perspective or just from a business practice. Or when you went through this, what were some of the ones that kind of jumped out first? Like, wow, this is going to be really hard for the industry to comply with this, either from a cost technology perspective or from a business practice perspective.
Sure, Jim. So I looked at it from, the ecosystem, the market center ecosystem, and which participants, asset owners, it could be investment advisors, it could be brokers, could be outsourced providers, trading or anything, that are under a covered function. Those are the market participants. All of them are going to be impacted. Yes, a registered investment advisor is where this proposed rule is really being drafted and focused to. But if this gets, implemented in its current form, just think of the outreach and expectation that registered investment advisors are going to have to kind of their existing relationships. And David, you just touched upon it, that if an existing outsourced relationship subcontracts a service to a fourth party, if I may use that term, it's incumbent upon the registered investment advisor to know that and to kind of monitor that in the like. And so the first is what are the resources in the strains on the system? All parties are going to be impacted. When you really think about what floats to the surface, it's really the intellectual property. Okay, the intellectual property is, yes, it's alpha generation, it's security selection, it's risk management, but it's also, investment manager number one is using custodian A, supplemental trading firm B, pricing center C, and that would have to be transparent to the marketplace. And that is, a intellectual property that I feel is important to protect. And that's how an entity is running their business and what differentiates them. And to put a prescriptive measure and to have all of that information in the public domain, I'm challenged by that.
David, do you have any thoughts in this area as well, or do you want to?
Yeah. Thanks, Jeff. Thanks, Jim. I think one thing that really jumped out in me is really concerns around confidentiality. So something we haven't gotten too much into is that this rule actually has a requirement to disclose the names of your service providers on your Form ADV. which is a publicly available document. So you are required to disclose your service providers, their names and addresses, the covered function that they are providing. This is extremely problematic for many reasons. Certainly, potentially, business, secrets, or not even secrets, just the way people are running their business. Making this in a publicly available document, anybody in the public can go online and search Form ADV. It's not like Form PF and other forms that only the regulators would have access to. Really don't see why that should be required. And moreover, real confidentiality concerns and just real concerns on the value of that information and having to provide that to the public. One thing, as I know you all know, I mean, when you're undergoing, for example, is an alternative fund, when you're undergoing fundraising with investors, these are the kinds of things that confidentially, your investors would know about, your service providers and all of that. But that is all obviously confidential. I thought it was pretty glaring and a huge kind of oversight on the SEC to think that people should have to disclose kind of the confidential way they run their business on a document that anybody can get access to.
Yeah. And Jim, just think of the bad actors in the marketplace that are trying to extract information and really think of from information security purposes, right? What does that mean to them? I don't even want to speculate, but it's different than where we are today. The other thing, if I can add, is if you're an investment advisor and you're making the determination on the ROI of either maintaining an insourced solution or engaging an outsourced solution, with this extra burden and expectation and governance about fulfilling this proposed rule, would a decision maker, an investment advisor, actually say, you know what, maybe it's easier, cheaper, faster, and less, I guess, and I have less headaches if I just insource it. And that actually may not be the best solution for the asset owner client. And so that subconscious or potentially conscious decision, because of this potentially burdensome proposed rule, is concerning as well.
Yeah. Whenever they put information in the public domain, something that we try to encourage them to just think about is how that information fits with other information that is available in the public domain and how that can be used by a bad actor. All right. So, I mean, I know that there are some things around, we did some work around shareholder ID where some information was being made in a public domain. And then when you take that information and you put it together with another piece of information, you can really pull together some powerful information that can be used for, nefarious reasons, for lack of a better term. All right. So listen, we have we're coming down to the close here. Next steps, final version. I mean, I know comment letters are due in late December. I do think that STA will be writing one. It'll be pretty narrow in scope. It's not going to be, sure, David, MFA, you're going to be writing something that's going to touch on a lot of different areas around here. I think where we're going to probably just narrow our attention is just on the impact that this will have to outsourced trading and supplementary relationships. But I am curious, just trying to get your thoughts on. I mean, I know it's really hard to obviously predict weather, but just what are your thoughts on the next steps? I mean, do you think that, or a final version? Do you see where's one area that really needs to be like, listen, they have the ability to adjust the proposal before they make it final? Like, is there one particular, or a couple particular areas where you really like they got to do a lot of work on this particular part because it is not in a final version?
Yeah. So to your point, Jim, so we've been working on our comment letter and engaging with lots of member firms on strategizing there. So the way that the process will work is, we'll submit our comment letter this month, and then the advocacy is far from over.
Yeah.
So to answer your question, I think the biggest, I think the concerns we've talked about here are all need to be adjusted. The definition of covered function, the definition of what outsourcing means, what a service provider, some of the, relationships Jeff was talking about, like how you got to go to the fourth line, the fifth line, and the ADV certainly. So the advocacy definitely does not end. It actually begins at the the submission of a comment letter. So similar to what both of you do and a lot of, members, engaging with the SEC themselves. And so what we try to do in the letters is offer alternatives of ways to make the rule better, more narrower. And so in our meetings, we'll have several meetings with the staff on this rule. That's what we try to do. Can't make any predictions, but hopefully I do think that the pushback on this and the advocacy that, the goal is to make the final rule a lot better and a lot more narrow.
Yeah. Jeff, what do you think?
Just, we're going to consider the resources, size, and scope of all investment managers. All right. We can't sway this proposed rule that, benefits the larger firms because they're just they have more employees or more resources or what have you. Second thing is we're going to continue to promote competition amongst service providers. Is this rule going to, is it going to stifle growth? Is it going to increase growth? All right. And then, what we use a lot, Jim, is on the market structure side is let's do no harm. Okay. And the do no harm, you touched upon it before, adding incremental information into the marketplace. Is that just another piece of that mosaic for potential information to be, gleaned out there, and how that information could be used from somebody that probably shouldn't be using it?
Yeah. Well, that's great. I mean, also, I do hope that there is a good outcome on this. I mean, we do. Listen, as a general statement, we don't mind when regulators get involved in creating standards on certain areas, as long as the standards are being done with a lot of input from the industry. A benefit with having standards is that the vendors come in and now they're just kind of competing somewhat on price because they know what the standard is. So it's all being, they know what it is, they know what has to be provided, and now they're competing more on price than bells and whistles that are things that maybe are not necessarily required on it. But obviously there's a lot to be done between now and then. David, to your point, filing the comment letters is just the beginning. It's just the beginning, and the amount of meetings and time is going to be enormous on this. I'm just going to leave with one closing remark. I won't put either one of you in a position to really to answer this, but I think the concern that I think that we have here also is the burden that this will put on the SEC to ensure that whatever the final draft is of this rule is being executed properly, that they are able to that they have the resources internally to not just this one but the other ones that they have out there. This is a very ambitious agenda at the SEC. This is just one example of around 30 rules they have out there, and I do wonder how they are going to be able to satisfy their requirements and making sure that these forms are being filled out properly and that the rule is being adhered to. So that's just, I'm going to get off my stump right now and I'll end it right there. Okay, so I want to thank you both for coming on.
Thank you.
Anyone listening in here, we're going to have probably one more call by the end of the year. We do hope that everyone has a good final month of the year. Don't forget, you got to run through the tape here, and I just want to thank David. David, thank you, and Jeff, thank you as well.
Appreciate the opportunity.
Thank you.
Thank you.